ever. Best students ever. So today we're going to continue our conversation about income. And we're going to talk about what the IRS considers to be income on Form 1040. So before we do, it's important for us to go back and revisit our conversation about Circular 230, which is an important point that we made about Circular 230, which had been amended, and this was effective in 2011, was that the rules of professionalism and etiquette apply to those preparing substantially all of a tax return or refund. So previously, that wasn't part of Circular 230. So the intent of Circular 230 was to guide the behavior of professionals such as CPAs, attorneys, but we said that to prepare a tax return, you don't need to be a CPA, you don't need to be an attorney, and we know that there are a lot of people out there that are preparing tax returns, and this is something that concerns the IRS. They feel like that there are some issues around the advice that tax preparers give taxpayers. They feel that there's no consequence. They don't have a license that they could lose, for example. They can't be disbarred. So Congress had amended Circular 230 to say that those that are preparing substantially all of a tax return are considered practicing before the IRS. What else is considered to be practicing before the IRS? So a CPA would be somebody who can practice before the IRS. We said a CPA can practice. Anybody can't just practice before the IRS, right? So we said there were some specific individuals that could practice before the IRS. We said a CPA was an example of someone who could practice before the IRS. We said an attorney could practice before the IRS. A registered tax preparer could practice before the IRS. And then we said, well, that being said, what does it actually mean to be practicing before the IRS? We know who can practice before the IRS, but the question is, what does it mean to practice before the IRS? So one of the additions was, if you prepare substantially all of a tax return, that's considered practicing. Before the summer of 2011, that was not the case. We said also that if you represent a taxpayer at an IRS hearing, that's considered to be practicing before the IRS. If you're corresponding with the IRS regarding the rights and privileges of the taxpayer, that's considered to be practicing. But what's not considered practicing? What would be an example of something that's not considered to be practicing?
Like there was a witness.
Exactly. So Giselle said, not Giselle, Giselle, also known as Genesis, right? Genesis says that if you appear as a witness, if the IRS asks you to appear as a witness, to give testimony basically, that's not practicing. You're just there to share information. You're not consulting, you're not giving it a covered opinion, you're not giving advice, you're not representing the client, you're just there to share information. So something that they might ask you, for example, you say, well, what kind of information? Why would they call you as a witness? Maybe they want you to speak to the salary that was paid the taxpayer by your company. So you're going to be a witness. What else is not an example of not practicing before the IRS?
Prepare documentation.
So furnishing documentation. So if you send an extra copy of the taxpayer's W-4, which is their withholding, right? Or an extra copy of the W-2 for that taxpayer. So you work for McDonald's, you're sending the IRS at their request for a former employee their W-2 and a copy of the W-4 that they prepared. That's not practicing. You're not practicing. You work for McDonald's. The IRS contacts you and asks you to send them this information. And you do. You're not practicing. That's not practicing before the IRS. But today we're going to talk more about preparing a tax return, and so that's why it's important to put it within that context, to know that tax preparers are bound by the provisions of Circular 230, which is intended to guide the behavior of tax preparers and other professionals, like we said, CPA and attorneys. Now, the IRS, Congress basically, has made an important distinction as to what they consider to be income. So when you fill out a 1040 tax form, the IRS doesn't want to just know your total income, they want to know the sources of income. So what is the source of your income? They know how much money you made, but they want on the 1040 form for you to list all the sources of income. So what are some examples of income? So wages, salaries, tips. What else? Interest. And we said that if the interest is more than $1,500, if you earn more than $1,500 in interest, you have to fill out Schedule B, right? Dividends, government said dividends. Alimony. So yes, right? If you receive alimony, importantly, alimony and child support is not the same thing. If you receive alimony, that's taxable. Child support is not taxable.
Taxable refunds?
Taxable refunds. There's definitely a question about that on the exam. Taxable refunds, absolutely. And for rents, we're going to prepare Schedule E. So taxable refunds, we need to be able to make sure that's handled properly. Some of you guys didn't get this. This is Schedule B. You guys got that. So that's Schedule B. So if you have interest income of more than $1,500, you have to fill out Schedule B. And you have to list all the financial institutions that paid you interest and the amount for each one. So you have to list Chase, $850. Citibank, $3,272. All the financial institutions that paid you interest have got to be listed there with the amount. All right, any other sources of income?
Yes.
Unemployment. Pensions.
Social Security.
Yep.
Business income.
Business income.
Capital gain.
Capital gain losses.
Yep, capital gain or loss. Farm. So this is Schedule D. Yes, farm income, business income, construction income, No!
No construction.
No construction income. Construction income is not an item on the 1040. But farm income is.
Yeah.
Business income is, but not construction income. It doesn't mean that you can't work for a construction company. It doesn't mean you don't have wages from a construction company. You do, but that would be reported as your wages and salary. That's where that would be reported. Not as construction income. Doesn't matter who you work for, that's still reported as wages. Anything else? What are we missing? A few others?
Yeah, other gains and losses.
Other gains and losses, IRA distributions.
Do you have rental real estate?
Yeah, we have.
Okay.
Yes, that's Schedule E, right? So, let's talk about Schedule E. So imagine we own 2 homes. We own 2 homes. One of them, we rent. So we have a house that we're renting. The rent is $1,700 a month. That's what the tenant pays us. Now, we have a lease with the tenant. A signed lease. That's important because that's going to help verify the amount of our rental income. So if you get, even if you only get a letter on it, what the IRS might ask you for is to provide a copy of the lease, provide a copy of the signed lease. Because they're thinking, well, maybe you are collecting $2,700 a month, and you decided, well, I'll only put down $1,700 a month. So they want to be able to verify the amount of your rental income. At a minimum, they might just send you a letter and ask you to send them a copy of the rental agreement. So, we have this income. What Schedule E highlights for us is the fact that we're able to deduct the expenses associated with renting that property. So what we're going to do is we're going to fill out Schedule E. So I told you that $1,700 per month is how much we're collecting in rent. So on line 3 is where we're going to fill in the amount of the rent received for the year. So everybody see that on line 3? It says income, rents received. In column A, that's for the first rental property. If you have more than one rental property, then you would fill out column B and column C accordingly. So we just have this one rental property. It's not too bad to have, right? $1,700 a month we're collecting in rent. So how much is that per year?
20,400.
Genesis says 20,400, so that's correct. 20,400. That's what we should put on line 3 in column A. 20,400. So 20,400 is the rent that we collected. That's our income. Now we had some expenses. So Congress says we understand that there's expenses associated with renting a property. They're not going to tax us on the rent that we received. They're going to tax us on the amount of money that we're left with after we covered our expenses associated with that property. That seems reasonable, right? So it's not the 20,400 that we're going to pay taxes on. It's an amount less than that. So let's see what our expenses are. So the first line for expenses is advertising. Advertising is $500. So the house was vacant. What did we do? We had to advertise. We had a management company that charged us $500 to advertise the property. They posted it online. They posted it in local newspapers. They put signs in front of the house. That's $500. So we pay $500 for advertising. Questions about that? So that's an expense, and we have proof. So importantly, we need to have proof of payment for these expenses. Remember, it's not enough to have an invoice or a bill. Remember, I told you, if you want invoices, I can give you all the invoices you want, right, Sylvia?
Yes.
Invoices are not a problem. It's proof of payment. So if you get audited, you're going to have to provide proof of payment. A check is a good proof of payment. A canceled check is a good proof of payment. They believe you. The IRS believes you. If you tell them you had $500 in advertising expense for this property, they believe you. They believe you a lot more, Godwin, if you have the canceled check. There's some auto and travel expense that we could deduct. We didn't incur any. So in our example, that's going to be 0. So line 6, we put 0. Auto and travel expense. But we do have some cleaning and maintenance. So we're renting the property. We need somebody to take care of the lawn. So somebody has to put down the fertilizer, somebody has to put down the weed killer, somebody needs to mow the lawn. So we're paying somebody to do that. You might want to ask the tenant to do it, but if they don't do it, it's more of a headache for us. So if they don't do it, then you're going to get hassled by your neighbors, by the homeowners association, the town or village might give you a ticket. Your grass is 2 feet high. And they'll leave a note in your mailbox that said, "Jack, you're making our neighborhood look like hell." So we decided that we were going to hire somebody to take care of the lawn. Go ahead, Godwin.
Question, and if they have a pool, the property have a pool, is that part of the...
Yeah, if you need to have the pool cleaned and maintained, sure.
Okay.
And you have proof that you paid somebody to do that? Yeah. So in this case, the expense that we had, we don't have a pool, but to take care of the lawn is $1,500.
Is city property considered your property if it's just like on your side and you're maintaining it?
Well, it has to be within the property line. So if you're paying to clean somebody else's property, that's not covered. But you should have a clearly designated area that's your property and what's your neighbor's property. One really simple, basic way you could tell, like from without dealing with surveyors or anything like that, is just see where your neighbor stops mowing, because you'll see that your grass is 3 inches and his grass is half an inch, and that must be the property line right there. But if you need to, you could find out. So $1,500. Now, the property was vacant. We had a property management company find us a tenant. Their fee, their commission, was half a month's rent. That's $850. So we paid them $850. That's an expense. Questions? We have insurance on the property. We're renting the property, but we have insurance on the property for damage to the dwelling and for liability. So we have a homeowner's policy specifically when you're renting. So it doesn't cover the personal property. It covers the house itself, the structure. So if there was a fire, for example, and liability. So if there was something negligent about the way we operated the property and somebody fell, for example, we would have coverage for that. We would have liability coverage. So that's, we have insurance, we pay for insurance. And even if we're not at fault, the insurance company will still defend us. So the policy for the insurance is $2,000 a year. And we have a canceled check. Right, Jack? So we have a check, a canceled check for $2,000. That's how much we paid the insurance company. The renters should also have insurance to protect their personal property. Because again, this policy doesn't protect the property of the tenants, their personal property, their clothes, their furniture. We could deduct legal and professional fees. In our situation, we didn't have any. So that's zero. So line 10 is zero. But as mentioned, we did hire a property management company. They get 10% of the rent. So they collect the rent, and they collect 10% for themselves, and the 90% they wire to our account. So how much is the management fee that we had to pay for the year?
2,040.
Right, so 2,040. So that's 10% of the 20,400. Out of the 1,700 that they collect, they take 170 for themselves. So each month they take their 10%. And at the end of the year, we got a statement that verified that we had paid them $2,040. Now this property that we own, we actually own with the bank because we have a mortgage on the property. So we're paying interest. Now Congress says that if you're paying a mortgage, if you're paying interest on a mortgage for a rental property, you can deduct that. So in our case, the interest that we paid was $18,460. That's the amount that we paid for mortgage interest on this rental property. We'll talk about Schedule A for the property that we live in. This is specifically the mortgage interest paid on this rental property. Is that a lot? 18,000. You're like, how much is that a month? How much would we be paying a month? Just in interest. So if in a year we paid $18,460, how much would it be per month that we're paying?
1,538.
So $1,538, approximately $1,600. $1,538 we're paying per month, just in interest. So if we had, to get an idea, let's see, how much would it be if we had borrowed $200,000? What would be the monthly payment? So now keep in mind that the monthly payment includes principal and interest. So when we make a mortgage payment, part of the payment goes towards the principal, which is that $200,000 that we borrowed, and part of it goes to interest. Now, when you first get the mortgage payments are amortized. So every month, part goes to principal, part goes to interest, but like within the first 5 years, most of what you're paying is interest. Which seems to make sense. Like here we're saying $1,538, $1,600 a month just in interest, and maybe $300 to principal. So go to bankrate.com and we could look at how much our mortgage payment would be if we borrowed $200,000 at 10% interest for 30 years or 360 months. So $200,000 at 10%, 360 months. How much would our payment be? If it was $200,000 at 10% for 30 years, Giselle is saying it's what, 1755?
1755.14.
So 1538, we said that we're paying 1538 in interest. That means if we had borrowed $200,000 at 10% for 30 years, that means in this case, we would be paying about $200 towards principal. That's the way the mortgages are amortized. So every month your principal owed goes down a little bit. And so your interest goes down a little bit. Little by little. Over 30 years. So this is a reasonable approximation. This is a realistic scenario. If we were paying about $1,500 a month, $1,550 a month, in interest and $200 towards principal, our payment would be approximately maybe $1,750 or so. And Giselle said that, yeah, if we borrowed $200,000 at 10% over 30 years, then our payment, our total payment would be like $1,755.
Yeah, actually they did the amortization schedule,
Mm-hmm.
and the principal payment was like $88 and the interest like $1,600.
$88 at $1,600?
Yeah, for the first month.
Okay.
And then the second month is 89, 90. Start paying 200 like in about a couple years.
A couple of years, right? So what was it? The first year was how much?
The first
Month,
month
yeah.
was 88.48 for the principal, and then the interest is 1,666.67.
Okay.
So basically, you're not meeting on your loan at all. The bank is making all the money.
So this number, although you might be kind of surprised to see that big number, 18,460, you're like, where does he get these? What does he just make this up? Well, no. So we could see, based on what you guys verified, that yeah, that's realistic. You might actually be paying on a loan if you borrowed about $200,000 at that interest rate. Now, interest rates currently are much lower than that, but for our example, we're assuming it's 10%. You probably could get a mortgage for 5%, but for our scenario, we're assuming it's 10%, and that's a realistic amount. Whether it's $1,500 or $1,666 or $1,650, approximately, that's how much we would be paying in mortgage interest. So that makes sense for our example, this number. It's not just random. It makes sense, right? So that's how much we paid for mortgage interest, and Congress said that if we're renting a property and we incur that expense, that's something we could use to offset our rental income. Then we didn't have any other interest. Line 13 is 0. But we did have some repairs. Now, the repair in this case cost us $4,100. So we had to have the hot water heater replaced. It cost $4,100 to have the old hot water heater removed and to have a new one installed. With regard to repairs, it's important that we note we could only offset our rental income. We could only deduct those expenses that we actually paid. So the reason I mention that is because when we think of repairs, sometimes we may have repairs that were covered by insurance. So if we had a leak, for example, and let's say, for example, this hot water heater, it leaked, and it caused damage to a hardwood floor. So the hardwood floor was damaged, and it had to be removed and replaced. That cost $10,000. But the insurance company paid that. They paid for that. They paid to have that replaced. Now, they won't pay to repair your hot water heater. They will only pay for the damage caused by the leaky hot water heater. So the $4,100 we paid. So importantly, we can't deduct the $10,000 because that's something that the insurance company paid for. Now, on a policy, on a homeowner's policy, there's a deductible. So our deductible could be $2,000. So in this case, $2,000 is the deductible and $2,100 is for the hot water heater. All right, so that $2,000 was, we were out of pocket, that $2,000. We could deduct that as an expense. The amount that the insurance company paid to the contractor, we can't deduct that.
So that's why I think a few classes back you talking about like, you know, non-CPAs and taxpayers when they itemize like deductions. That's what we try to avoid, so they don't try to add on to it.
Well, the concern of Congress, you know, the IRS, is that that some taxpayers are getting advice about exaggerating the expenses that they have. So Congress feels that that's something that needs to be addressed. And so that's why they revised Circular 230. So that all tax preparers, regardless of whether they're a CPA or attorney, have guidelines, professional guidelines. So again, of this, $2,000 is a deductible that we paid of the insurance. That's something that we could offset, we could use to offset our rental income. But again, what the insurance company paid, we can't deduct. We can't deduct expenses that were paid by somebody else. So we had the hot water heater replaced, and $2,000 we paid to fix the floor, our contribution towards fixing the floor, so that's $4,100. The next item, line 15, is supplies. We didn't have any expenses for supplies. But line 16, we had property tax. We had property taxes that we paid. So property tax is deductible. So on this property, again, not the house that we live in, the house that we're renting, the property tax that we paid is $3,900. Now, to Chris's point, Chris was suggesting that there may be some issue around that some of these numbers could be exaggerated. That's the nature of the discussion that we were having. So we want to point out that this amount is reported by the mortgage company on a Form 1098, and they send that to you. So at the end of the year, you might be thinking, I don't know how much I paid in mortgage interest. All I know is I was paying that $1,755 that Giselle told us. But they send us a statement, and it says on there how much she paid in mortgage interest, and it also says how much was paid for property tax. Very often, when the mortgage is set up, the mortgage company will take responsibility for paying the property tax. So they report that on the 1098. That's part of your mortgage payment. But not always. You could pay the property tax on your own, but this number is definitely known. So sometimes taxpayers, they think, well, I could just make that $28,460. Well, you could, but you would definitely get audited, and the IRS knows. They know. And so one of the debates is around, why do we have to spend so much time preparing tax returns when most of the information the IRS already knows? Schedule B, we're just going to spend time. Sylvia here has money in 10 different banks. She's got to list each bank, each financial institution, and the amount of interest that she's received. But she's getting a 1099. The 1099 that she receives from each of those banks is also sent electronically to the IRS. So they know how much interest she's earned. They know what it's going to say on her schedule, what it should say on her Schedule B. So yes, this is a 1098, this is a 1099. So Schedule B, the information that we're looking for is on a 1099. And the mortgage statement is the 1098. So that's the property tax. We said it's $3,900. And let's see. Utilities, line 17 would be utilities, but when we rented the property, we told the tenants that they would be responsible for the utilities. They're responsible for the water bill, they're responsible for the electricity, they're responsible for the gas. So we don't have any utilities. We didn't pay any money for utilities. The tenants paid all of that, so if the tenants paid it, we can't deduct that. But we can deduct depreciation. So the depreciation for this property, we're saying, is $10,000. So for this year, we're depreciating the property by $10,000. It's a rental property. We can depreciate a rental property. How much is our total expenses now?
Probably 350.
43,000?
Yeah, it's 350.
43,350. That's our expense. So our income for a rental property is $20,400. Our expenses, now this is not a typo, our expenses are $43,350. So now sometimes people say, you know what, I have a tenant, I'm not going to report the income. Why would I want to tell the IRS about this $20,000 that I'm collecting in rent? Well, because you're required to, but then what I wanted to show you with Schedule E is that, well, it makes a lot of sense to fill out Schedule E, not because you're required to, not because you're legally required to, and not because it's the ethical thing to do. Both of those are absolutely correct. But look at all these expenses and look at the impact that this is going to have on our taxable income. So we're going to have a loss from this property. So that's what we're going to put on the next line, line 21. We actually have a loss of $22,950. So actually, as it turns out, while we were concerned, some of you, about reporting $20,400 in income, I'm going to have to pay tax on that? Coach, you really are crazy. Nobody would report that. A lot of people do report it, but what I'm showing you is that it makes sense to report that because actually, not only are we going to have income of $20,400, so we're actually not going to increase our taxable income by $20,000. We're actually, by filling out Schedule E, going to be able to reduce our taxable income by $22,950. So you know what the tax shield on that roughly is? How much we're going to minimize our tax? Approximately $6,000. So that's how much tax we're going to save. We're going to reduce our taxable income by this amount. So that translates to the amount of tax that we owe. It translates to a savings of about $6,000. So that $22,950 is also going to appear on line 25. So Schedule E. Questions?
So Professor, you're saying if they have a loss, they would still have to pay taxes?
In this case, we have a loss of $22,950. So what we're going to do now is on our 1040, on Schedule E, rent here, what we're going to put is $22,950. So that's an amount that we're going to subtract from our wages and salaries. Questions? Does everybody see Genesis' point? So we went through, we talked about all these sources of income. So rents are a source of income. But what we put on the 1040 for rents, for that line, is based on what we computed on Schedule E. So our computation on Schedule E, the reason why we go through Schedule E and we have to fill out that separate form is because then, when we get this number here, that bottom line, Remember we said this is the income, all these are our expenses, 43,350. We subtract that from this, and we get a loss of 22,950. So that 22,950 we put on the 1040.
Line 17?
Line 17, yes. That's what we put there. So you guys see that on the 1040? So Maria said that on line 17, on line 17, that's where we're going to put the loss. It says rental, real estate, royalties, partnerships, S-corps, attach Schedule E. So we attach Schedule E, but the bottom line number, this loss, 22,950, is what we're going to put on line 17. So you see all those items, all those other sources of income? That's going to be reduced by this amount, by the 22,950. Questions about that? So that's what we do with that number. You prepare Schedule E and then you say, well, what do I do with that? Now that I've gotten this number, what do I do with it? We take that and we put it on line 17, like Maria said, on the 1040. Questions?
This rental Schedule E, that's for like major companies, like major real estate places.
So Schedule E, no, it could be an individual. So
I know individual, but is it like, what about like major, like those big apartment buildings and?
oh, okay. So then they would have to do an 1120. So if they're operating as a business,
Right.
they would have to fill out a corporate return. So if they're a corporation, they'd have to fill out a corporate return, which is 1120. Are we good? So you're going to have a rental property. What do you think? Is it a good idea? You're not going to make any money, but
break-even is best.
at least you can deduct the losses, right? Maybe we have to increase the rent. You show your tenants this, they wouldn't believe you otherwise, right? They're like, oh, that landlord is getting rich. Every month he takes my money. You show him this. So yeah, I should increase your rent, make you pay $2,500. All right, so that's Schedule E.